In today's discussion, we're delving into the intricate world of shorts and how they obscure liquidity risks, margin calls, and the entities driving market movements. According to recent insights from AMC Bigham's tweet, J.P. Morgan Chase 10K filing with the Securities and Exchange Commission reveals a staggering $0.498 trillion in off-balance sheet exposure by the end of 2023. But what exactly does off-balance sheet entail? These are potential assets or liabilities like unused commitments, letters of credit, and derivatives, which aren't directly reflected on the balance sheet. Such items can pose various risks, from credit to liquidity and counterparty risks, not fully disclosed on the standard balance sheet. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. This revelation raises significant concerns, especially when we consider other major players like Citadel, Bank of America, and Goldman Sachs. With J.P. Morgan revealing such a substantial off-balance sheet exposure, it's reasonable to infer that other banking giants might have similar or even larger undisclosed risks. The exact extent remains elusive, but the implications are profound. If one bank is concealing $0.5 trillion, it's plausible that others are employing comparable tactics. Furthermore, it's not just banks engaging in such practices. Hedge funds are also culpable. Past data has hinted at the prevalence of undisclosed short positions and derivatives, amplifying concerns about liquidity and counterparty risks. These risks are paramount, particularly in the context of recent warnings to hedge funds and institutions to bolster their liquid assets to weather potential margin calls. Liquidity risk has been a recurring theme, intertwined with margin and settlement issues. Recent directives urging institutions to shore up their liquid reserves underscore the gravity of the situation. The convergence of banks facing liquidity challenges alongside hedge funds amplifies the urgency of the matter. Counterparty risk, particularly concerning short exposures, adds another layer of complexity. Concealing trillions in counterparty risk unveils the magnitude of the crisis lurking beneath the surface. The narrative spun by short sellers, downplaying their exposure and urging retail investors to sell, unravels when confronted with the staggering reality of hidden risks. Institutions like Citadel, heavily involved in shorting AMC, find themselves in precarious financial positions. The urgency to offload AMC shares becomes clearer when considering the looming specter of defaults and collapses, exemplified by the recent struggles of institutions like UBS. The recent emergency repo injections, exemplified by the $112 million infusion, highlight the acute need for cash in certain quarters. While dwarfed by the magnitude of off-balance sheet exposures, these injections hint at broader liquidity strains. Such events underscore the interconnectedness of financial markets and the precariousness of current conditions. The narrative attributing AMC recent price movements solely to retail investors regaining interest is disingenuous. Retail investors have consistently demonstrated their commitment to AMC, contrary to attempts to portray their involvement as sporadic. The underlying strength of AMC investor base, coupled with market dynamics, drives price movements rather than sudden shifts in retail sentiment. Moreover, the disparate treatment of news regarding AMC and other institutional-owned stocks highlights a troubling bias in media coverage. Issues plaguing institutional favorites often receive scant attention compared to similar challenges faced by retail darlings like AMC. The disparity in coverage underscores the need for a more nuanced understanding of market dynamics and media influences. The relentless shorting of AMC, despite its imminent profitability and positive outlook, raises questions about the motives behind such actions. Citadel and Virtu involvement in naked short selling further compounds concerns about market manipulation. The emergence of Citadel-backed entities like Hidden Road Partners underscores the opacity surrounding these practices, further eroding investor confidence. In conclusion, the intricate web of shorts, hidden risks, and market dynamics underscores the need for greater transparency and scrutiny in financial markets. The narrative propagated by short sellers and media outlets often obscures the true extent of risks facing investors. As retail investors navigate these treacherous waters, awareness of market dynamics and hidden agendas is paramount in making informed decisions. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.